All right, my friend. So I had a guy email me last night. Nice guy. Worried about the market, saying, "Could I do something to share people who are freaking out about the markets for retirees and whatnot?" I figure I'd just take a minute in between. I'm down in my little basement slash gym, and I just looked at the market today as I was getting ready to do a video on my blackboard. I got a couple things I'm going to talk about in terms of looking at four different funds from the beginning of September till today to show you which ones have actually done well in a down market. I think you'll find it interesting. And then I'm looking at the S&P 500 VOO, and as you can see, we got lots of red there. That color is kind of weird. Okay. And the S&P 500 right now is down 2.43% for the day. And the interesting thing is, if you look at the chart, the year-to-date return on the S&P 500 as of the close of Friday is 4.75% in the black. In the black. All right. So even after today, let's just say it ends up down 2.5%. So the market will close here in 18 minutes. All right. So, hey, what's going on, Donald? Even if it ends up 2.5% down today, we are still in the black by 2% or so. Now, I'm not trying to make light of this, but that is not horrific by any stretch of the imagination. And this is why I hate when we look at year over year performance as opposed to intra year. And I don't have the chart here, but I use this chart by JP Morgan every year. So Vanguard's got the number one thing on economic forecast that they produce every year. JP Morgan has the second one, and this is actually probably my favorite, but I like Vanguard better, so I'm biased towards Vanguard. But the JP Morgan one is just friggin' phenomenal. And they'll show this intra-year declines each and every year. The market on average drops from top to bottom within the year 14% each and every year. Now, we don't see that if we're just using year over. I don't have my mic on. Hopefully, y'all can hear me okay. If we're just using year over year over year, we don't see the volatility intra-year. We don't. And I think that's a huge problem for investors, especially folks who are about to retire, because they think a couple things. And this is, again, my frustration of the market industry as a whole. Oh, the market averages 10% a year. It does if you start from year one and end in year 20 and don't take money out, don't do anything, just sit there. Yes, that's fine. But on any given year, on any given day, on any given 3 years, it's not like that. It's not. The market's up and down every single year from top to bottom. The market moves. And when it does, that's when people panic. They don't wait until, I'm not going to panic until 31 December and then see if I should do something. That's not how it works. They panic like right now. Like my friend who emailed me said, man, I'm worried because I'm about to retire. Or maybe I can't remember. But, right now I'm down. I've lost, should have jumped out the tallest building is only 2 stories. Yeah, so Money says, hey, Josh, call my broker and ask him, should I jump out the window? And he says, hell yeah, but the tallest building is only 2 stories. We do this every single year. Every single year, the market goes up and the market goes down. You guys got my phone, so I can't tell you what the 10-year treasury is. But anyway, I was talking to an earlier guy today. 10-year treasury is back down to 2.8%. And there you go. When the 10-year treasury goes down in value, generally speaking, that means the market is going down in value. The 10-year treasury goes down in value, that means, or it goes down in yield, I should say, excuse me. That means it's being bought up, because what generally happens when the stocks makes people nervous, they go to the path of least resistance, which is bonds, government bonds in particularly. And so you see the stocks falling. You'll see the yields on government bonds dropping. The reason the yields on government bonds drop, because the demand for those bonds goes up. Notice that we've had a bunch of raises over the Fed's raise this whole year, and yet the yields have gone down. Interesting, huh? Just kind of goes to show you that the idea that the interest rate market is driven by the Fed is driven certainly by demand for bonds. The Feds can do whatever they want. At the end of the day, that will give you a short inclination of the markets in terms of interest rates and yields and whatnot. It's demand, man. That's all there is to it. Demand. When the demand for the bonds goes up, regardless of what the Feds do, it does not matter, because today you can go buy a 10-year treasury and you will get 2.83% on your money. 6 weeks ago, you could have gone by that same 10-year treasury, one that is issued at that day, and got 3.25. That's a 50 basis point drop in yield from 6 weeks ago till today. And the only reason that happened is because the Fed's raising. You can drown in 6 inches. Well, yeah, you can drown in 6 inches of water. Exactly. That's what my man Donald Steyer says. I don't want to go. Well, let's just put it this way: a lot of people are worried about gun violence. We always say we have more babies dying in 6 inches of water in the bathtub than we do by. That's one of my pet peeves is gun violence. I say there's a lot more word of some of that out there than someone shooting you. That's for sure. But anyway, be it here nor there. But this is what I'm talking about. At the end of the day, the markets, they go up, they go down, they go up, they go down throughout the year. And to react, because today the market is down the Dow is down 555 points. We're still in the black for the year. Now, I will do this video on this because I got some notes. I was looking at a couple things, and I'll put a video on there. So I was running and I'll just share with you why I'm live here. I was running 4 different scenarios on 4 different funds. I thought it was pretty interesting, actually, because I like the SWAN defined risk fund, not the fund, the defined risk separately managed account. I've talked about that in a video before. I'm not saying you should buy it. I don't get paid on this. I'm not making an investment recommendation. I don't know. I just know it's a hedge, literally a hedge where they're buying options to offset the volatility. And I said, what? Now, they have a mutual fund that theoretically does the same thing. I thought it'd be interesting to see what they were able to do to avoid the volatility on the SWAN defined risk mutual fund relative to the S&P 500, relative to the Vanguard Life Strategy Conservative Fund, and relative to the Vanguard Ginnie Mae Fund. All right, and so basically I looked at the SWAN defined risk. Now remember, this is an option strategy, an option. They are buying puts. Is that what they're doing? They're buying puts. Yeah, so they're buying puts against the S&P 500 so they can put it to you later on down the road. I don't know the whole mechanics of this in terms of do we have to wait until the 3rd week of December? Is that the witching hour? I can't remember how options. It's been so long since I've been involved in options, I can't remember. But I wanted to see the volatility of the SWAN defined risk mutual fund relative to the S&P 500 and a couple other things. So 9/14, it was trading at $13.14. As the close of Friday, it is trading at $12.30. So it's down 6% from September 9/4, excuse me, from basically the first part of September until today, the last trading day. It's not even counting today. So the SWAN defined risk, which is a pure hedging where they're buying options to offset volatility, was down 6%, which I thought was kind of interesting because if you look at the separately managed account, it never had a year where it's down that much on any given year over year. It just is, I don't think, it's not since 1997. Yeah, I don't think so. So I thought it was interesting because in terms of the volatility protection, even on a defined risk option strategy, it did not give you a shield from volatility. The S&P 500, just using VOO over this, I was actually using VFINX, the Vanguard S&P 500 index, started on September 4th, the first day of trading in September, 267.18, and now it's down to 239.88, and that's down 10%. So the S&P 500 is down 10% over that time, and again, throw another 2% today. The Vanguard Moderate Life Strategy Conservative Fund, that's 20% stocks and 80% bonds, started at $19.95 in September 4th, and now is traded at $19.18 the other day. Oops, bear with me just a second. 19.95 minus 19.18 divided by 19.95. That guy is down 3.8% is the Vanguard Conservative Life Strategy Fund. Is down 3.8%. This is just price to price. So don't look at dividend, I'm just looking at price to price. Because that's really all that matters when you get nervous about volatility. Now here, my pride and joy, the Vanguard Ginnie Mae Fund. To the rescue, as always, the Vanguard Ginnie Mae. So it started September 4th at 10.13. What's it trading at now? 10.17. It's up 4 cents. Again, not much, but 0.04 divided by 10.13. It is up all of 1/3 of 1% over the last 10 days. Thus, as I always say, there's your hedge. If you're worried about market risk and market volatility, having some Ginnie Mae fund, I'm just telling you, man, if you look historically at take this for, I don't care. I just don't. Do whatever you want to do with it. But if you're looking at risk mitigation strategies and at least getting a little bit of yield, it's hard to beat the Vanguard Ginnie Mae. I mean, you're never going to make much money, I'm telling you right now, because it's a government bond fund. You're never going to sit there and tell your friends at the Christmas party, man, I got the Ginnie Mae. I'm the best guys in town. That no one cares. They're going to say, great, what did you do in 2009? I can't remember what it did. Then you can say, well, what I did in 2008 was I was up 7%. What happened to you? So if you're looking for risk mitigation, you don't have to go fixed index annuities or what's the other one I was talking to a guy about today? Variable annuities have guaranteed minimum income. You don't have to do any of that. If you truly want CDs, I'm okay with CDs. If you want risk mitigation, though, Vanguard Ginnie Mae is the way to go. Just remember, you aren't getting upside the stocks. You're not. And it's not Fannie Mae. It's not Freddie Mac. It's the Vanguard Ginnie Mae. It's a government national mortgage association. It is not Fannie Mae. It's completely different. This house that I'm in right now, for which you are watching, is backed by the government national mortgage association because of VA loans. The VA loans are used, they're lending through the Ginnie Mae, and that FHA loans do too. So you are literally, if you own Ginnie Mae, own this house, essentially. That's what's happening. You have loaned me your money, and I'm paying you back my money as through the Veterans Administration and Navy Federal Credit Union, and that's how it works. 100% backed by the feds. You don't have to get fancy schmancy here. So you say this is where I'm gonna do my video. What happens if you retired in 2000 in the down markets? And I'll do a couple of a sequence of return things. I'll do that here in a few minutes. But this is what I was going to do today because I was interested in that. I had a bunch of people when I was talking about Vanguard Life Strategy Growth Funds versus the S&P 500 versus annuitizing. So I've been wanting to say what it looks like if you did in 2000, 2001, and 2, or then again in 2008. So I was going to put that on the board here in just a few minutes. But anyway, so the whole point was, you don't need to do any fancy schmancy risk mitigation. You don't need any fixed index annuities that give you a guaranteed 3% as long as you lock your money up for 10 years. That's nuts. I just looked today at Navy Federal Credit Union. You can get a 2-year CD at 3%. I mean, there's nothing wrong with that. I mean, you're not going to make any money after taxes and inflation, but you're not going to lose. You're not. There's nothing wrong with taking a CD. Ladder those suckers. Get 1, 2, 3-year CD, 4, 5. I don't care. But there's nothing wrong with doing that. You say, all right, here's my Roth IRA money. That's my growth. That's my Hell's Bells money, swinging for the fences. That's my Jim Rice. Remember Jim Rice from the Red Sox, Dwight Evans, and Fred Lynn. Remember that outfield? Jim Rice in left, Fred Lynn in center, and Dwight Evans in right. Oh, man, what an outfield that was. So I got Jim Rice up to bat, and Red Sox would always try to hit those home runs because they knew they got that short porch off Green Monster. But anyway, you're not trying to hit home runs with Ginnie Mae. You are trying to hit home runs, i.e. with your Roth IRA or your aggressive stuff. So you say, that's my Roth. This is my safe stuff, and sometimes I need more safe and less Roth, and less risky. Then move it over. It's no big deal. I mean, ideally, I can sit here all day long and say, hang in there, hang in there, hang in there. If you're losing sleep at night, it ain't worth it. Just go and say, I'm going to buy a CD, ladder some CDs, 1, 2, 3 years. I'll get, on average, 3%. I got to pay tax on it. Inflation's at 2.5%. So after tax and inflation, I know for a fact I'm not making money. Nothing wrong with that. All right, so let's see in the 15 minutes I've been yapping here. The S&P is down 2.28. All right, so we haven't had any big thing here at all. Does that mean, literally, what does that mean? It means that people are worried about what? I mean, they're worried about the economy. Just 2 weeks ago, they're saying how great the economy is. Like someone was telling about Kramer. The economy's great. 2 weeks later, the stock market's bad, so the economy's bad. I'm telling you right now, the economy and the markets do not go hand in hand. It just doesn't happen like that. So right now, let's just say we're in correction. We're more than correction territory. A correction is 10%. A bear market is 20%. We're already here within the correction. I hate to say this, but we need a bear market. We do. And the reason we need that is to finally clear out these, since 10 years now. We haven't had a bear market. We had a small one, it was pretty big actually, about 33% in small caps. Is that 2015? In May of 2015, and then we had one in international, I think in the same year, 2000, I can't remember. We've had 2 bear markets in small and international in the last 10 years. We haven't had anything in the S&P 500, nothing. And we need one because every 4 years or so, we have a bear market. Actually, even worse than a bear market, about a 25% decline. So even intra-year volatility, we haven't hit a bear market in the S&P 500. We need it. We absolutely do. And I'm telling you, Joe, right on. So I'm telling you right now, if we're here, let's just get it done and get it behind us. It's almost like dealing with your nightmares. I hate spiders. At the end of the day, give me a spider, just let me deal with them, be done with them. So, okay, it's either going to kill me or I'll finally get over it. Here, we just need it. We need a bear market once and for all to get beyond this and say, okay, at least we have that bear market behind us. And that way, I think people could be less worried. So, lastly, if you will, the valuations, and this is where a lot of people, and I was talking, not talking, this guy, he was chastising me on the market timing thing, a video I did. I said, you can't time. No one called this. I mean, no one did. And he was saying, using what's called technical analysis. And I mean, my God, dude, price points, technical analysis, they use candle maker. I can't, the whole candlestick is silly. And I say you can't do it. No one did. No one that will. I mean, you might be able to get lucky and do it. No one can do it consistently. His whole point was the valuations were so high, and it's just the valuations aren't so high. I mean, he's like, everyone knows valuations are high. Hell, they've been saying that since 2009. Valuations been high. So if you've been basic your market planning on valuations being high, you've literally missed out in the last 10 years. The valuations are just not extraordinarily high. They're just not. Could they be lower? Sure. And that's what the market like this does. It makes valuations lower, which means that's a good thing to buy. But they're not through the roof high, my friends. They're just not. The CAPE, the cyclical, low power mode, the cyclically adjusted price earnings ratio is high. No other way around that. When you factor in like Siegel does in terms of the various mechanisms they look at to manage it, no one's sitting here and saying the valuations are through the roof extraordinarily high, other than people who've been saying that for a long time and they've been proven wrong. At some point, they'll be proven right. Maybe it's right now, but you just can't time the market. You either got to say, I'm in there for the lumps or I'm not. One of those two things. At the end of the day, if you can't handle it, we could easily go down to 15%. Get out. No one's going to yell at you. I'm not going to yell at you. No one's going to yell at you and say, oh, you're a wimp? Okay. I get to sleep at night. Go put in a CD for 2 years and see how things shake out. Nothing wrong with doing that. There's nothing wrong with doing that. I would just offer a couple things. Remember, you still probably got capital gains, unrealized capital gains in your taxable portfolio, so be careful there. Unlimited unrealized capital gains, even if we have a 10% decline right now, could be detrimental to your wealth if you sell stuff without thinking through. I might wait until the beginning of the year, so if I do have some capital gains, I won't have to pay them till the following year. Number two, if it's an IRA, it won't matter. Number three, I just ask you, don't do any Roth. Talked to a guy today, he had cash in his Roth and investments in his traditional IRA, and I just, please, and he recognized he made a mistake. I said, please don't do that. We want your Roth to be your aggressive account. Come hell or high water, let your Roth be your aggressive account to take advantage of the tax-free growth. Look, if you don't do it, I'm not going to yell at you. Y'all never know if you did, but if anything, let your Roth be your last-ditch aggressive account for sure. Your taxable account, if you want to pull out there, if you got some losses, like I said in my email today, if you're not a subscriber, subscribe to my email list. But if you aren't, if you're not, I sent out an email this morning about you need to take capital gains. This is a market. You need to do it by year end. Take capital losses, lock in those suckers now. Get those losses locked in. That way you can offset some of the capital gains that are certainly coming from your mutual funds. And at least you can use $3,000 a year against ordinary income, if nothing else. So lock in your losses. Now is a good time to say to the red, I'm going to take my losses. And when you see red like that, that means we got to take our losses off the table. Miss Sue from North Carolina emailed me or put a thing on there. If you take a losses as a wash sale, apply if you buy the same fund in an IRA. And the answer is yes. So you can't sell VOO in a taxable account and bank a loss and turn around and buy VOO in your Roth, for instance, within 30 days. That will violate the wash rules. You can't do that. You can't take the loss then. So what you got to do is say, VOO, I think you are close to bear market. I think you probably have momentum that would say you're probably going more likely to bear market than coming back up. So I'm going to sell you. I'm going to get rid of you for 30 days, and I'll come back in, see how things shake out, and buy you back then. That way I can bank in a lot. And again, this is assuming you have a loss. I don't know if you do or not. That's why I got to log in online and look at your accounts to see. All right, so lastly, if you have an investment advisor, and this is the email I sent today, and I just yapping here, but it makes sense. So I had talking to a wonderful guy in Virginia. He and his wife have 4 funds with a money manager. The money man, I've never heard of these funds, and that doesn't mean they're good, bad, or I just don't know. But 4 of them he had for a while. 2 were at losses, and 2 were at gains. And I say, why are we not selling the losses? And they're outside of a taxable account. So let's take those losses off the table. And of course, the investment advisor wasn't calling. I don't know what's going on. I was like, why is the investment advisor not doing this? I don't know. I'm sure he has an excuse. Frankly, I doubt. I don't think he would have. I said, sell those suckers. Let's get the losses off the table to bank the losses. Absolutely no reason to hold them, especially in these cases. The funds are charging like 1.2% anyway. So take the losses, lock it in. Because we're going to start doing some Roth conversions anyway. And if you're going to use Roth conversions, well, we at least like to have $3,000 we can offset against ordinary income, if not other things to offset against capital gains that we're going to get from other funds that this guy put them in. And so I'm sure he wasn't doing that. And so I said, you got to call the guy and say, I need to take a loss. And so he's going to do that, which is good. I had a lady out in California say, you got to sell these. And I talked about this the other day, Calmos funds, sell it, take the loss. Calmos funds is a good fund. Sell it, just take the loss. Let's bank that. Turns out she also has other capital loss carry forwards from previous years, which is good. But again, you got to look at until I looked at the tax form, I did not know that. I still would have given her the same recommendation, sell that puppy, bank the loss. But you got to look at your 1040. Do you have capital loss carry forwards from previous years? You'll see that on Schedule D. It's the Schedule D, and I forgot the line item. If you have taxable accounts, in this case, there's a living trust account. Remember, a living trust is still taxable to you as a grantor. The grantor is the person who funded the trust. Most likely, the grantor and the trustee are the same people. Not all the time, but most likely they are. So in her case, I said, call them up, look at the 1040, and it's a living trust. It all flows back to you and your Social Security. And she gave me the tax forms, and lo and behold, on Schedule D, it had pretty significant capital loss carry forwards, which would not have changed my recommendation, but that's huge because she also has a couple funds, the Fidelity Growth Fund, which I talked about, which is going to have pretty significant, I think it's like 6% distributions of capital gains against the net asset value, which is taxable as capital gains, other than the fact she has capital loss carry forwards to offset that capital gain. So it's a big deal. And if she didn't send me the 1040, I would not have known that. And that opens up a lot of opportunity that heretofore I was not aware of, was ignorant of. So you got to look at your 1040s, folks. If you're not looking at your 1040s and you're expecting your tax guy to do it, you're wrong. They're just not going to do it. Your financial advisor, i.e. investment manager, Edward Jones or whatever, if they're just managing investments, if they're not asking for your 1040, again, that's not a financial advisor. That's an investment guy. Nothing inherently wrong with that, but you got to put it on you to start looking at your 1040. Are there things we should be doing relative to the funds that we have? And the answer is probably. Again, if everything's a traditional IRA, not much you can do, or 401k. But if you have losses, bank them. If you have capital loss carry forwards, use those against other things, maybe high expense mutual funds that you would not buy today, but you don't want to sell because of the inherent capital gains that you have accumulated over many, many years. So you got a fund that's charging 1.25. You're like, man, forget that. Like, too expensive. I don't want that fund anymore. Let me sell that puppy. Oh, I can't because I got big gains in there. Oh, you look at your 1040, Schedule D, you see, I got 80,000 capital loss carry forwards. I got 60,000 of unrealized gains. Let's sell that sucker. Let's go to an index fund, and I don't pay tax on that whatsoever. And I also use those capital losses that I've accumulated in the past, which I will take to my grave, by the way. If you don't use them, you lose them, which means use them while you're alive, or else they just die with you. We don't want that to happen. So in this case, it's a win-win-win. You take advantage of your capital losses, you offset your capital gains, you get out of that crappy old mutual fund, and you can buy something a lot more efficient with less potential for future capital gains as well. Wonderful strategy, but you got to look at your 1040. All right, so lastly, while I'm yapping, I'm yapping a lot more than I anticipated. All right, if you have a wrap account, and this infuriates me, I'll just use USA. All right, so USA, we have these wrap accounts. You have a hell of a lot of holdings in there. Some are like 20 holdings in there. You look at them and say, man, I can identify losses on specific funds in here. You call up USA and Vanguard and Fidelity and Schwab, all these wrap accounts. You say, hey, I want to sell that, Joe Crappy fund so I can bank the loss. And they say, we can't do that. And you're like, why? Joe Crappy fund's down $20,000. I want to sell it so I can bank that loss against the other capital gains that you are going to distribute to me. We can't, because that would violate our model. That would change the way our model is, our asset allocation, because we're so comfortable in giving you a specific asset allocation that if we sell one thing, that violate that, and we can't do that. So I got to keep the loss? Yes. That doesn't make any sense. I don't want to keep the loss. I want to sell it so I can use it against other income. We can't. So what's my alternative? You can sell the whole thing. But if I sell the whole thing, I got to sell everything. That includes the stuff I have gains, which there are many more. Yes. That's why these wrap accounts are horrific, because you can't, I mean, you should be able to, but you can't specifically identify funds to sell, to take the losses. Now, depending on how much fees you're paying, depending on what kind of weight you carry the firm, some firms will probably let you do that. If you're just a regular old guy like old Josh here, and you got 50 or 75,000 in there, I guarantee they're not going to let you. They're going to say, no, we're not going to sell $6,000 of your stupid mutual fund to appease you when you're only paying us $800 a year in fees. That's the way they're going to look at it. $800 to them might not be much, but certainly a lot to you, certainly a lot to me. And I'd certainly like to bank that $2,000 loss or whatever it is, but they won't let you do that. So here's what you do. You say, screw that. I'm going to you're probably not going to be able to get this done by the year. And this is tough. This is a tough scenario to do this. And I'll probably do a separate video on this alone. You transfer everything in kind to a non-managed account. All right. So what that means is you say, well, if you all aren't going to sell this for me, I don't want you to pay your management fee, because I'm paying management for essentially nothing in this case. I'm going to transfer everything in kind. So I have Joe Crappy Fund, 100 shares of Joe Crappy Fund in your managed portfolio. I'm going to transfer it to a non-managed portfolio, i.e. a self-directed account. And you might see that sometimes on your statements. It'll say Josh Scanlon account S/D. That just means self-directed. I manage it myself. So I'm going to transfer my 100 shares from Joe Crappy Fund over to my self-directed account. All right. Now I also got to transfer my shares of, Charlotte Awesome Fund and, whatever, all these other funds that I got to go over there. I got to transfer them all. They won't let you pick and choose. So it's all or none essentially. So I transfer all these funds to my self-directed account. And then once that happens, now it should happen pretty quickly. We're not talking rocket science here. It's just paper, but it should, but I don't think you'll probably have time to get that done by year end. So should that happen though, you say, okay, now you go on your brokerage account. I show you how to buy a stock the other day, use my own USA account. The same thing is how you sell it, the exact same thing. Instead of hitting the buy button, you hit the sell. And then you say, I'm selling Joe Crappy Fund, and that way you can lock in the loss and without selling all this other stuff in there that would cause you a capital gain. I hope that makes sense. I'll do it differently on the board. I think it might be helpful. But just remember, you can do that. You can say, if it's a wrap account, all right, well, if you guys aren't going to work with me, I don't want to pay a fee for it anymore. So I'm going to move everything over in kind to my own brokerage account. Everything just flows over there. Nothing else changes. You have the same holdings, the same portfolio composition. You have everything sans, that's French for without the fee, just to let you know. French Canadian, man, with a lot of French Canadians up in Maine. I did learn that. Sans the fee. And then you can go and pick and choose the funds that you want to sell in order to lock in the loss without having to take the gains. And we'll talk about other things about transfer in kind. I think a lot of people don't realize how that can work. Lots of benefits if you understand the basics of transfer in kind. All right, so you can do that. It's a wonderful thing to do. If you have a wrap account, I'm telling you, especially if you don't have much money in there, they're just not going to work with you because they, frankly, don't care. I don't know how else to say it. They just don't. They just like your fee. They got you push button investment management, and they say, hey, that's good. Call us when you're ready. And you're like, I've been ready for 20 years. No one's ever called me. All right. So let's see what we got real quick before we close the shop up. So yeah, we'll see. So the markets have just closed 10 minutes ago, and the Dow was down 507, it looks like. So 2%. S&P was down 54, 2%. And there you go. So we're still in the black for the year. Nothing has really changed relative to if you made money at the beginning of the year to today. The answer is still yes, you have. No other way around that. You're down, 15% since the beginning of September or so. What are you going to do? Are you going to get out, lock in those losses? I don't think you should, unless you can't sleep at night, because I bet you don't have losses. I bet you still have gains. Why do I think that? Because you're up big time last year and you're still up for this year as well. I bet you have specific funds that have losses sell those puppies as long as it's not in an IRA, because IRA won't do any good from the tax consequence. But look at the funds you have that have losses, got negatives, not just year to date, but since you've held them, your cost basis relative to the portfolio value. If your cost basis is $100 and your portfolio value is 150, you don't have losses. If your cost basis is $100 and your portfolio value is 75, you have losses. That's all that matters. Cost basis versus portfolio value. That's all that matters. Regardless of when you bought it, it doesn't matter. If the cost basis is higher than your current account value, you might want to think about selling it. Everything, I don't know. I had a guy email me today. Well, you should be. He was kind of, messing around with me, but he's in the business. You got to disclose that. Look, I'm not telling you what to do. You should disclose tax consequence. If you have losses and you're not planning on selling those losses, or at least thinking about it, you're making a mistake. Should you go out there just because old Josh from YouTube said yes? No, I just do what you got to do. But if you're not thinking about it, hopefully now you will be thinking about it. All right. Hope this helps. A lot longer than I anticipated because the yapping right here, Mr. Yap. But if you have any questions, thoughts, concerns, put them down in the show notes, and don't forget to log in. And I just started a PayPal thing. If any of this stuff helps and you want to donate to your old buddy Josh, I'll put a link in the show notes. I'm not too ashamed to ask for money. If you want to give, say here's $5, I appreciate it. I'll put a link in there. It's helpful. I got 4 kids, man. You gotta help me out. But if you do, I said, that'd be I get this quite, not a lot, but I get enough people say, hey, I'd like to contribute. Well, hell, I'll put a thing in the show notes. I'm happy to take your money for sure. $5, $10, whatever you want to do. If it helps you, if I saved you $5 or $10 over the course of your financial planning time and you want to donate to your buddy Josh, I'll be happy to put the link in the show notes. And I appreciate it for sure. But don't feel like if you don't, you can't watch the videos. I don't know who you are. All right, my friends. So we'll see you next time. Be on the lookout for my the thing I do here on the 4 different scenarios relative to starting in 2000 2000. I think is what I'm going to do. I got to think it through a little bit more, but we'll stay with you guys. Thanks, guys. All right, bye bye. I got to turn this guy right there.